Welcome back, everyone in YouTube land. This is your tinfoil hat economist coming back to you at the speed of light, episode number 16, Inflation or Deflation. Well, the inflation mongers, I will call them with a friendly tone of voice, are again on the warpath, predicting we may see much higher rates of inflation in coming years due to the extraordinary amounts of federal deficit spending and expansionary monetary policies on the part of the Federal Reserve. That's the central bank of the United States. Central Reserve is buying a few $1 trillion of bonds and lending money through programs that are indecipherable. So will we see higher inflation? You can see a headline in Barron's over the weekend. Today's stimulus spending will lead to tomorrow's inflation. And then we had a column on March 24 from Arnold Kling, a very smart blogger, and he said, my thoughts. Right now, we are laughing at the people hoarding toilet paper. But wait a few years. When toilet paper is $50 a roll, we'll see who's laughing. So he says the stimulus, he's referring to the federal deficit spending and perhaps what the Fed is doing, is amounted to 20% of GDP. Since GDP isn't going up by that amount, we will have 20% more money chasing the same amount of goods, so prices ought to rise by 20% at some point. But it doesn't stop there, he warns. Inflation is a social and psychological phenomenon. At some point, people lose their belief that money and government securities are a store of value, and then you get the Weimar Republic Zimbabwe outlook. So, bad inflation on the prospects are for bad inflation by the viewpoint of several experts. Then something funny happened today. In Japan, the governor of their central bank, the Bank of Japan, announced an even more aggressive monetary stimulus program. They've been holding interest rates on 10-year Japanese government bonds at 0.1%. They've been doing this for several years. Japan's national debt as a fraction, or percentage, I should say, of their GDP is 225%. In other words, Japan government owes 2 times their GDP to Japanese government bondholders. The Bank of Japan has purchased back about half of that. And this year, Japan's national government, the Shinzo Abe administration, is running a huge national budget deficit. I think it's at 9% of GDP. I could be wrong on that one. So what did Haruhiko Kuroda, the governor of the Bank of Japan, say today? He said that the Bank of Japan's 2% inflation target will likely not be met in the next several years. But he wasn't talking about they would come in high, above 2%. He was talking they would probably come in low, under 2% for the next several years. They may even have deflation this year. Of course, they import all of their oil, and oil prices, now we're seeing about $14 on the WTI on oil prices. So Japan in deflation, despite large federal budget deficits in Japan and monetary expansionism much bigger than we see in the United States. So where do I stand on this inflation versus deflation debate? Well, I have to say, with all due respect, the people who have been predicting higher rates of inflation have been doing so since 1980. We had some real luminaries in the macroeconomic profession. Paul Volcker, the former chairman of the Federal Reserve, highly regarded. Martin Feldstein, I believe he was chairman of the Council of Economic Advisors in the Reagan administration, Harvard professor, again highly regarded. They both spent decades and decades and then more decades predicting higher rates of inflation and thus higher interest rates in the U.S. from about 1980 on. They both recently and sadly passed away. before their predictions ever came to reality. So now we have people again predicting higher rates of inflation. I don't buy it. I think we're going to see modest rates of inflation for the next several years. Now, there is a fellow by the name of Olivier Blanchard, or Blanchard, depending on your pronunciation. He's a former MIT prof and Fred Berkston Senior Fellow at the Peterson Institute. And he writes, and I think sensibly enough, the standard way of thinking about inflation is to look at the state of the labor market. In the US, we're looking at 20% unemployment, and God knows where it's going to end up under these horrible lockdowns. Inflation expectations we see from what's called the Treasury Inflation Protected Securities Market, or TIPS market. We're seeing investors anticipating inflation of about 1% for the next 10 years. You can sell a 10-year US Treasury today for 0.6% interest. So people are willing to part with their money for 10 years. These are institutional investors are willing to part with their money for 10 years for 0.6% interest. I don't think they anticipate much inflation. Shocks, and then reading from Blanchard further, and shocks to commodities and food prices. This framework of predicting inflation has served us decently for the last 30 years, probably 40 years. And through these lenses, it's hard to see inflation pick up anytime soon. And I think he's right. We won't see inflation pick up soon. So what does this mean for stocks and gold? I'm still very cautious on stocks. I don't think the second leg of the bear market has come around yet. We're seeing, call it 10 or 15% corrections in stock markets, depending on which index you look at globally. That doesn't strike me as enough. And the second aspect is gold at 1,700 an ounce. You never know with gold. You see, gold is like an oil painting, a collectible car, a collectible postage stamp or coin. The value of gold is not set by the income it can probably generate in future years, the way a rental property or a stock or a company. You buy a company, you're hoping to make, say you buy an actual company and you hope to make $1 million profit for the next 5-7 years. Beyond that, you're not sure. What will you pay for that company? What will you pay for an oil painting? You're not going to get any income from it. You're making a bet that somebody else will buy it in the future. That's not always an unwise bet, by the way. Plenty of people, seeing that in China, mainland China, incomes were rising and there was a new superclass of ultra-wealthy people invested in Chinese artifacts, things of historical value, or vases, works of art, did quite well because the disposable income was there. It was adequate to finance these kind of purchases in art. So we may see gold prices go up a little bit in the future, but inflation is not in the cards, which means gold prices may be in a little bit of a bubble here. So that's my outlook for today on April 27. I look forward to seeing all of you in episode number 17. And best of luck out there in the stocks and gold markets. And best of luck to all of us in getting through to economic prosperity in the years ahead. So this is your tinfoil hat economist signing off at the speed of light. And I will see you in episode number 17.